Hello, this is David Hillier here, and I'm going to be giving you a short video on capital budgeting and real options. This video is going to be an introduction to real options. It's not going to last very long, and I'm going to be talking about three main types of options. One is the option to expand. The next thing is the option to abandon, and then the third one is a timing option. Now, this all comes from my book Corporate Finance, and it's section 8.3, and that is part of an overall risk and capital budgeting chapter. So, let's start off with the option to expand. Now, when we talk about options, there's a lot of mathematical theory underlying options. The approach I'm going to take in this video is one which is much more intuitive and quite basic, but it gets across some of the ideas. Later chapters in my book go into the theory in a lot more detail and the valuation in a lot more detail. But here we're just going to talk about the what options really mean and how options have an impact on capital budgeting. The normal analysis that you would undertake in capital budgeting would be like an NPV analysis. But NPV analysis is very much a static methodology. You get your forecasts. You start off today. You get your forecast going into the future, and you come up with a viewpoint of whether the project is good or whether the project is not worthwhile. But in reality, you're making decisions all the time. You might decide today to open up a new facility, and your plan is to run that facility for 5 to 10 years. But next year, if next year comes, you may not have achieved what you expect. You might have to decide, well, okay, we might need to abandon this project. Now, NPV analysis assumes that you're actually going to stick with the project for, say, 5, 10 years, the lifetime of the project. But real options bring in a strategic element to your decision making and a dynamic element into your decision making that allows you to incorporate decisions at points in the future to expand or to abandon. So if you take this simple, stylized example, you've got an entrepreneur who is basically doing some type. I've got here. It's learned of a chemical treatment causing water to freeze. Okay, and then based on that chemical treatment, the entrepreneur wants to open up an ice hotel. Now, if you take the one ice hotel, you get annual cash flows of £2 million, and the initial investment is £12 million. Now, we're going to assume, like we assume for any company, that this is going to be a perpetuity. So we use the perpetuity formula, and you can see here that with a discount rate of 20%, reflecting the risk, we have a negative NPV. Now, that negative NPV would then suggest that we don't go forward with the project. However, uh, the entrepreneur has a decision. If the project is successful, if one cash flow, if the project is successful, then the entrepreneur can expand. And in actual fact, the this £2 million isn't just one figure. If you take the stuff that I've done in sensitivity analysis, that £2 million is just an expected figure. And the entrepreneur actually comes up with that £2 million as an expected figure based on two types of forecast. One is the optimistic forecast, and the other one is a pessimistic forecast. The optimistic forecast is that the cash flows will be £3 million, and the pessimistic forecast of the cash flows will be £1 million. And those two scenarios have a 50% probability of occurring. So if we say, well, okay, we have pessimistic and we have optimistic, So the pessimistic is 3. So the pessimistic is 1. The optimistic is 3. The probabilities are 0.5. So what's the expected? Well, the expected is simply the pessimistic outcome multiplied by the probability that that occurs, plus the optimistic outcome multiplied by the probability that that occurs, and that's where you get the 2 million. And so in the original NPV analysis, where we say that we expect cash flows to be £2 million, it's disguising a much more detailed analysis, which is saying that, well, in actual fact, we're optimistic, and we've got, if we were optimistic, we would think that we'd get £3 million, but it's equally likely that it won't be that successful and we'll get £1 million. So we've now taken the kind of the one analysis of the 2 million and now expanded it into an optimistic forecast and a pessimistic forecast. Now, at this stage, you might say, well, does this really help us? Because if we try to calculate the NPV for the optimistic forecast, you'll see that well, we have the initial investment of 12 million, and then the perpetuity of the 3 million pounds discounted at 20%. It gives us an NPV of 3 million. You might think, well, that's excellent. The pessimistic forecast, where we're only looking at £1 million cash flows discounted at 20%, we get an NPV of 7 million. Now, you might say, well, okay, does this really help us? Because if the NPV is 3 and if the pessimistic forecast NPV is -7 and the optimistic forecast is 3, given that both outcomes are equally likely to happen, then what is the expected NPV? Well, it's just the NPV in each scenario multiplied by the probability of that scenario, and you add them all together, like I'm doing here. And you end up getting the -2 million NPV, which is the exact same as what we do if we're just treating, the expected cash flows. So you might think then, well, okay, does this really help? Well, it does help because so what we can do is we can look at this particular case and say, well, we have two decisions really. If it's pessimistic, if the bad outcome occurs, then well, that's we've got to accept that. But if we have an optimistic outcome, that is that in actual fact we're getting 3 million in cash flows, leading to £3 million NPV, then we can expand the project. We can expand the project into a number of other areas. This may seem unrealistic, but it's actually quite common in business. If you think of a restaurant, you open up a restaurant, you have a good working model for how that restaurant should operate. It brings in cash flows. If you're successful, you tend to see restaurateurs will open up other restaurants of the same type of model. And that is the option to expand. And you can see that in lots of different areas. If you have a new product that's doing well, then you see the company expanding with other products of the same type, different models of the same product. So what we're going to do is we're going to say, well, okay, we've got the initial NPV. The initial NPV says that, well, it's expected to be -2. We're going to incorporate strategy now. So we're going to say, well, if it's pessimistic, then we just have to take that on the chin. If it's optimistic, then what we're going to do is we're going to expand, and we're going to expand into 10 different locations. So if we expand into 10 different locations, then we have uh, the pessimistic case, which is -7, and that's an NPV. There's a 50% chance that we're going to get -7. But if we're optimistic, then we're going to expand, and we're going to expand, and we're going to expand into 10 new locations. The 10 new locations, again, the optimistic outcome is 50%. So we have a different scenario now. Now, what we're doing here is we're looking at NPVs. So you might actually ask a question, well, what about the initial investment? Well, the initial investment is, another way to do it is say, well, if it's 10 and if it's a good outcome, then you're going to have an initial outflow of 120 million, and the cash flows are going to be 30 million forever. Okay, because all we're doing there is we're just let's see, one dot 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 dot. So what we're doing here is we're just multiplying this by 10. If I was to find the NPV, then the NPV is just equal to minus 120 plus 30 divided by zero point 0.2, and you see that we've got the total NPV of expanding into 10 locations is 30, and that's what I've written here. All I've done is just multiplied the NPV by 10 to get that. You can uh, take both directions to arrive at the final destination. So what's the NPV now if you have the option to expand? Well, the NPV, if you have the option to expand, is the probability of the pessimistic outcome multiplied by the NPV in the pessimistic scenario, plus the probability of the optimistic outcome multiplied by the NPV of the optimistic scenario, and you've got an NPV of 11.5. So incorporating the option to expand will actually transform what may seem as a negative NPV project into a positive NPV project. And you can see that here in the slides that I've got. Okay, so the option to expand is a very valuable, or can be a valuable option, and this methodology of real options allows us to incorporate that. Now we're going to look at an analogous case, and this next case is the option to abandon. And the option to abandon is similar, but what we're going to do now is we're going to say, right, okay, well, you've got a different situation, so let me just clear all of these. So I'm clearing uh, the spreadsheet. We're going to look at the option to abandon. And again, it's the same type of thing. So you've got an optimistic outcome and you have a pessimistic outcome. So let's just write these: pessimistic, optimistic. Under the pessimistic outcome, the cash flows, the annual cash flows will be minus 2 million. Under the optimistic scenario, the annual cash flows will be 6 million. Both scenarios will have a probability of occurring of 0.5 or 50%. Now, what we're going to do here is we're going to have a similar type of scenario, but instead of having the option to expand, and let's assume in this particular example you have no option to expand, in this case you have the option to abandon. So the option to abandon means that what you'll do is, again, it's a dynamic analysis. So you start off at time 0, you enter into the project, and then in time 1, you then say, well, is the project going to work or is the project not going to work? If the project is going to work, then you carry on with it and you receive the annuity or the perpetuity of 6 million going on forever. But if the project is not going to work, then you abandon it right immediately. So we have two scenarios, and what we're going to do is we're going to calculate the NPV of each scenario. So under the optimistic forecast, we're going to get cash flows of 6 million per year, and that gives us an NPV of 18 million pounds per year. Under the pessimistic forecast, we have a loss of 2 million pounds per year, and that gives us a negative NPV of minus 22 million. Now, if we look at this and we calculate the expected NPV, the expected NPV is simply the probability that the pessimistic scenario occurs multiplied by the NPV in the pessimistic scenario, plus the probability that the optimistic scenario occurs multiplied by the NPV of the optimistic scenario. And you can see here, as I've got in the slide, that the expected NPV is negative. So just looking at this particular case, you would reject. If we're going to exercise the option to abandon, then what we're going to do is we're going to continue on with the project if it's optimistic, but if it's pessimistic, we stop after 1 year. So what happens then? So if we stop after 1 year, uh, we have a different cash flow stream because you've got the initial investment and you only have one cash flow. So it's not a perpetuity anymore. You abandon the project after 1 year. The initial investment is 12 million and you get 2 million in loss after the first year. Now, what's the NPV of that simple cash flow stream? Well, the NPV of the cash flow stream is, let's just look at the present values here. The present value of -2 discounted at 20% is minus 1.667. So the NPV is the sum of these, and we're given an NPV of minus 13. So what we've got is we've got, under the pessimistic scenario, instead of having a negative NPV of minus 22 million, if we abandon, we now have a negative NPV of minus 13.67 million. And the expected NPV then is transformed from being negative 2 million, into positive 2.16 million. So the option to abandon allows you to strategically stop projects, and the method of real options allows you to value that option to abandon. Again, similar to option to expand, it's a really important type of methodology in capital budgeting. It's not used that often, and it's not the most common type. But as you can see here, it really can capture some strategic possibilities that NPV just can't do. So moving on, we now look at the option, the timing option. Now, I've got here, actually, just before I move on, it's just it comes from the book where I discuss, not just a one stage, one stage model, but you actually have a number of stages, and there's an option to abandon in each case. So we're now just going to finish off now with just a discussion of timing options. This is a very common occurrence with mining firms, with construction firms. And what you've got here is you've got basically a situation where a company owns a piece of land, and that land can be put to productive use. It may be to extract gold, it may be to extract silver, copper, any raw material. It could be for agricultural products, or it could be, in this particular example, to build on it office space, and so then you can rent it. But it may be that at this point in time, the cost of extraction may be much higher than the income you're going to get from the actual commodity. So, if you were to start extraction now, if it was a mine, you would say, well, okay, costs are very high, revenues are low, it's a negative NPV, so you abandon the project. But with the timing option, what you then do is you say, well, okay, we don't start now, but we'll wait until the future. We'll wait until maybe 5 years from now, when the cost of the commodity are much lower than the revenues that you'll get from the commodity. The same goes in this particular case for rents. Rents might be too low at the moment, but if you wait, they can be much higher in the future. Now, the methodology it's real options. The method that you would use is a binomial option pricing model, and I will cover that in a future video related to a chapter further on in the book on options. So at the moment, I'm not going to show you how to value the timing options. That is something for the future, but it's worthwhile just to know that these exist and they are valuable to a company. Okay, so that was a very quick run through of real options. I spoke about the option to expand, the option to abandon, and timing options. Options are scary things, in terms of people get a bit put off because it can be a lot of mathematics. But if you look at the examples that I've just given here, and they are simple, stylized examples, as I've said earlier, you can see that you can quite simply incorporate real options into your analysis. And they can add value to your decision making. You may end up choosing projects that you would have otherwise rejected with NPV. So hopefully this has been of value to you, and thank you very much.